Alright, so today I have planned a lot of things. Last time we discussed a little bit financial markets, financial instruments. Today we got the long task of actually seeing which are these financial instruments. So write them out. Financial instruments. Financial instrument, I already explained last time, is the same as financial asset. Sometimes these are known as, and they're called paper assets. Paper asset. And a lot of times in finance, especially in investing, they just call it paper. Now, repeating from last time, we have the opposite of financial asset is called real asset. Real asset. Real asset is an asset of its own value. Real asset is a watch. It has its own value. Coffee has its own value. Gasoline, table. Usually these are things that you can touch, you can feel, including the shirt. Of course, the most popular for people will be real estate is a major real asset, okay? Car, motorcycle will be real asset. Real assets usually fall in two categories. They'll fall into the category of real estate, and they'll fall in the category of commodities like oil, gas, copper, zinc, and so on. This is real asset. Real asset has intrinsic value of its own. Financial assets do not have a value of its own. A financial asset is a claim on somebody else. Now, the best definition and the best way to understand financial asset is that it is an asset which is someone else's liability. So, every financial asset is an asset and at the same time a liability. It is liability for the issuer. So for issuer, it is a liability. For the owner, it is an asset. Okay? Now, let's draw the line. There are many of them. I have about 20. Where's my other little sheet that I have with the table? Yes, that's the one that I want. You guys pass around. You can take a photo if you like. Number one, we begin the simplest, the easiest. Everybody that you knows and everybody that you have in your pocket. It's called currency. Currency as in money. Okay? If you pull out a nice little dollar, okay, it will usually be issued by the central bank. So, currency is a liability of the central bank. Sometimes, in some countries, it will be a liability of the government, as in the Treasury, okay? And it is an asset for whoever owns it. Next one on the table is Treasury bills. Now, notice here in the little table, when it says instrument, okay, which stands for financial instrument, they say U.S. Treasury bill. It does not have to be U.S. It could be European, could be UK, could be Japanese, could be for any other country. Treasury bill. Again, all of these are financial instruments. Become a financial instrument issued by the Treasury. In this case, it's going to be U.S. Treasury. Treasury means the government, okay? So, issued by the government. And here's the second little part. Bill. For short-term financing. So, the bill part means for short-term financing. With a maturity of usually less than 1 year, usually. Actually, if it is more than 1 year, it's got a different name. Let's give it a try. Number 3, it's down the road. Treasury note. Treasury note, again, financial instrument issued by the Treasury with a maturity between 1 and 10 years. So this one is less than a year. It becomes a bill is a money market instrument. The note is a capital market instrument. Capital market instrument. Okay.
So if it's 1 year, it's still a bill.
Well, it's still a bill. You can call it a bill. Yeah. The 1 year is a little trickier. It's always a trickier. Next one. Commercial paper. Commercial paper is a security issued by companies, as in businesses, okay? So, now you begin to notice how I do the definitions. I always start a financial instrument. Oh, let's write it over here. Financial instrument, as in financial asset, as in paper asset, as in paper, is also called security. Security. Now, let's explain the word security. Security, back in the old days, everybody understood when they still used their brains, okay, and observations. Everybody understood that paper assets in paper was risky. Paper asset is a claim on somebody else. A claim on somebody else means that it is someone else's promise. A financial instrument is simply a promise by someone else to pay. It is as good as a promise. So back in the old days, people understood things are either as good as gold, meaning 100% sure, or as good as a promise, meaning very risky, not sure. So back in the old days, people understood that paper is extremely risky business because you gotta trust somebody, because it's someone else's promise, because somebody could disappear or vanish or die, okay? Anything could happen with a promise, okay? So back in the old days, everybody understood that these financial instruments are very risky. So they had to design a name to make people feel better and more confident. So they designed a name to be misleading, to be security. There is nothing secure about security. Securities are very risky, but they call it security and say, oh, you got a security, and you think you got a security as in it's secure. Secure is the same as sure, but it's not. It's just a name. It's just a word that was designed for people to think about something that it's not, okay? So, commercial paper, back to the definition. You can say, is a financial instrument or security issued by businesses for short-term financing. Days, how many? How many days? Maturity up to 270 days. So they'll issue commercial paper. Usually they like to do them round numbers. 30 days, 60 days, 90 days, 120 days, 180 days, and up to 270. Next, not in the table. Not in the table. Let's write it out in red. Fed funds. Fed funds. This is tricky. Fed funds means a loan of one commercial bank to another commercial bank for the purposes of satisfying minimum reserve requirements. Now, it's even more than that. It is a loan of a deposit at the central bank. So, let's say, because I'm the only one here, it's easy for you to understand, is I am the central bank, okay? You are commercial bank A, and now you're commercial bank B. You have with me 1 million deposit. I'm the central bank. You got 10 million deposit, okay? Now, you need 3 million, and you need 3 million. The money that you need with me is called required reserve. So, you need 3, and you need 3. You have 1, you're short 2, okay? What you have to do is you have to borrow. So you borrow from somebody who has more than they need. She needs 3, she has 10, she has a surplus of 7, so you will borrow 2. What you borrow is called Fed funds, Fed funds, okay? So, she will lend you 2 million of Fed funds, okay? Usually, Fed funds is a brand new word. Well, you probably should have studied in banking. Overnight. Overnight means a loan with a maturity of 1 day. Means a loan that you borrow today and must repay tomorrow. So that's Fed funds. Usually serves the purpose of satisfying required minimum reserves. Next, repo 6. Repo stands short for Repurchase Agreement. Repurchase Agreement has 2 meanings. One is the legal meaning. By law, technically, It means that someone borrows money, okay, someone borrows money, and you give them a securities in return. In other words, let's say you borrow money from me, you will give me your securities. I'll keep those securities as security. And then, when you pay me back, I will give you back the securities. Now, technically, it is a sale. The securities are technically sold and later on repurchased. This is the legal definition. The economic definition is a secured loan. In other words, the one party makes a loan and provides some securities as a security. Remember, you can provide gold for security. You can provide your house for a security. From last time, when you provide your house for a security, we call the loan a mortgage, okay? You can provide your motorcycle for security. You can provide anything of value. When that particular value would be short-term securities, short-term low-risk securities, in the form of sale and repurchase, it's called a repo. Next one.
So,
Yes?
and repurchase price would be agreed beforehand?
Yes, the repurchase date and price will be always agreed beforehand. Usually they'll say a 30-day repo, but there is no reason to not to be 15-day repo or 2-week repo. Could be a 7-day repo, could be 60-day. It is always agreed, meaning pre-agreed, exactly how many days and exactly the purchase price back. So whatever the sale price is, whatever the purchase price is, the difference between the sale price and the purchase price is the return. Remember, there is no profit in these operations, the return, okay? So that's the repo. Next one, negotiable certificate of deposit. Negotiable CD. Certificate of deposit is just that. It is a piece of paper, like a certificate, that you have a deposit with a commercial bank. So a CD is simply a deposit with a commercial bank, okay? And that deposit could be potentially bought, sold, or done a whole bunch of other things. Now, the word negotiable has a very special meaning. It means that, again,
It can be traded.
it can be traded. There's an exact legal meaning. It means that you can transfer the title. You can transfer title. In other words, ownership can change hands. In other words, if it's your CD, you can transfer it on to her. Non-negotiable CD means title cannot be changed. Ownership cannot be changed. You cannot give it to somebody else, okay? You cannot transfer it. You cannot sell it. You cannot do anything with it. With negotiable means you can transfer ownership to somebody else. Well, if you can transfer ownership, this means you can actually sell it. And if you can sell it, this means you can negotiate the price. So negotiable here means, the economic meaning is that you can actually negotiate and bargain the price at which you could possibly sell it, or you can use it as a security. So if you put money in the bank in the form of a deposit, and you got a certificate of deposit, maybe let's say 90 days, but you need money tomorrow, you can use the CD as a security to borrow from the same bank or from any other bank, okay? So the CD can becomes negotiable. You can put it with another bank, and that other bank will give you a loan. If you pay back the loan, they will give you back the negotiable CD. But if you don't pay back, they will keep it or take it. They'll take ownership of the CD to satisfy their loan. Next one. 8. Very tricky. Very tricky. Let's put it in red. MMMF. You can zoom in a little bit, right?
Yeah.
Stands for money market mutual funds. Okay. First thing to understand, and that's the hardest part, is that a mutual fund is a financial institution. It's not an instrument. It is a financial institution. Okay? So, mutual fund is a financial institution. Okay? It is a fund which invests in money market instruments. That's the fund itself. So, when you have ownership in a money market mutual fund, it's like you own a share of the money market mutual fund. It's like you're an owner. It's like a share. It's a share of ownership, okay? And that share of ownership, it's called redeem. You can take back the money at any time. In other words, you can sell it back to the fund, and the fund will give you money. So, money market mutual fund is a financial institution, and that financial institution will issue its own share. Well, that share of the mutual fund, of the money market mutual fund, will be considered the instrument. That's why it's tricky. It's tricky because it means two things at the same time. It has meaning of a financial institution. It has the meaning of an instrument issued by that particular institution. So, money market mutual fund is considered to be a short-term instrument or a money market instrument. Next, Eurodollars. Let's see. Eurodollars. And Eurodollars usually stands short for Eurodollar deposit. The word euro means in a foreign bank, in a foreign country, okay? Back in the old days, originally it meant in Europe, where dollar deposits were made in British banks in London, okay? But now you may have dollar deposits in Germany. Most of you have dollar deposits in Cambodia. I got a dollar deposit in my home country of Bulgaria. So these are all Eurodollar deposits. Now, you may have a euro deposit, as in a euro currency, okay? And if I have a euro deposit here, it's going to be called a euro deposit. Euro meaning in a foreign bank, and euro meaning in the currency of euro. It could be called a euro-yen deposit, meaning it's a yen deposit somewhere in a bank outside Japan, okay? So that's a euro-dollar deposit. Let's see what they say about it. They say up to 1 year. Next one, commercial credit loan, number 10. Commercial credit loan, it's actually very nice. We can shorten it just for a commercial loan. Is a loan usually or most often made by a commercial bank to a business for commercial purposes. Now you need to understand what's the meaning of commercial. Commercial means, again? Yes! Perfect answer! For making money. How do we call that kind of money that you make? It's called profit. In other words, commercial loans are loans made to businesses for the purpose of profits, for the purpose of making profit or generating profit, okay? These are what we usually call business loans. Business loan, it's the same thing. Now, these could be short, 6 months, these could be 9 months, but commercial loans could be 2 years, 5 years, 10 years. Usually it becomes a capital market or long-term loans, okay, long-term loans. Next one is on the table, pay attention, US notes. I already covered US note as in Treasury note. So Treasury note, you can write equals US note in that particular sense. The note will have a maturity between 1 and 10 years. Next. Mortgages. 11. Remember, mortgage is a loan secured by real estate. Now, it may be commercial mortgage. Commercial mortgage will be a loan made to a business for business purposes, meaning for profit purposes, and secured with real estate. Commercial mortgage may be secured by a factory, okay? It may be secured by some sort of equipment, like, let's say, oil refinery, gas refinery. It could be some kind of a plant, let's say car manufacturing plant, okay? With all the machine, equipment, building, and everything else. That's a mortgage. It could be mortgage made to households to buy real estate. Or it could be made to a household to buy anything they want to buy, meaning they can spend it on vacation, on buying a car, on paying hospital bills, or whatever. It's secured by real estate. Next, municipal bonds.
Sir,
Yes?
what if the loan is not secured by real estate and secured by something else? Would that be considered mortgages?
Well, that's exactly the definition. If it's not secured by real estate, it is not a mortgage. It's something else. It could be a commercial loan, it could be an unsecured loan. It's anything, but it cannot be mortgage. The definition is loan secured with mortgage. If it's not secured with mortgage, with the real estate, it's not a mortgage, it's something else. Okay? Municipal notes. What's the maturity on a note? Let's take a look and find out. Municipal. Oh, is it municipal? Oh, they have bonds here. Is it bond, right?
Yes.
Okay, municipal bonds. These will be, a bond is usually a very long-term instrument. Sometimes 2 or 3 years, a little bit more often 5 years, but most commonly they're going to be 10-year maturity and 20-year maturity. Municipal means local government. Local government means in the United States it will be a particular state, the state of Ohio. Municipal means of the city or of the county. It could be for the United States particularly, but maybe applying for other countries, it could be a school district. In other words, it is a government institution which is not the main central government. So the central government does not relate to the central government, could be only to a region, okay? Here, as in Thailand, you have provinces. It could be issued by a particular province. It could be issued by a city in the province, okay? Or it could be issued by a particular area within the city. For example, particular area here will be what? Tulkok, okay? So they may issue their own bonds and use only for the local area, okay? So that's municipal. Next one. 13. Corporate bonds is a bond issued by corporations. Usually 10 years, but it could be any other. All right, let's see what else we've got here. 13, corporate bonds. I got another one which is not in the little table. It's called agency bonds. Agency means that it's not owned by the government, but is somehow sponsored by the government. It is known in short as GSE, standing for Government Sponsored Entity. Government Sponsored Entity. And I'll provide some examples. A government-sponsored entity, for example, the US government and many governments around the world. I know my Bulgarian government has such an entity for farming. It's very big in Thailand. Thai government has got a very big agricultural policy where they want to promote agriculture, and they promote agriculture by providing special agricultural loans. These we call, let's write them out, one of the many types of loans, we call these farming loans. Farming loans, you can say, are loans made to farmers, but that's not exactly true. It is loan made for agricultural purposes. It doesn't have to be a farmer. The question is not who gets the loan. You can get the loan. The question is, what is the purpose? How the money will be used. So it is used for agricultural, as in farming. Usually the borrower could be a farmer, but it could be a business, as an agricultural business, okay? So these are farming loans. So GSEs may provide, number one, farming loans. So it's going to be a government-sponsored entity. In other words, kind of like a government bank. Okay, it's supported by the government, it's subsidized by the government, it is probably created by the government to stimulate a particular business. One such business will be farming. Another, much more important and bigger business will be housing. As in, helping poor and middle-income families buy a house. So, a GSE will be providing loans to lower-income people to help them buy a house. It's going to be usually a loan that the commercial bank don't want to make because the loan is too risky. Someone with relatively low income, not a very good job, not a very stable job, but the government says, okay, we want to try to help these people. We give them a chance. So they'll give them a mortgage for the purpose of buying their own housing, okay? Now, housing can be divided into two major categories. One is called residential. Residential. And the other one is called commercial. Residential has two different meanings. Residential means a place where people live and sleep, okay? And here, residential has the second meaning, a place which will be owned by the people as their main residence. In other words, the government will subsidize and help you only if you buy your own house for you to live in, okay? The other one is commercial. Commercial means either for business purposes or investment purposes, where you buy the house but you don't live in it. You rent it out for income. You rent it as a business for commercial purposes, okay? Well, the governments will usually stimulate only residential housing. They say, we don't want rich people who have 6 houses, right, renting out 5, to buy 6 more houses. That's not our goal. For this, you got commercial land. We want to have that poor family, there are 2 low incomes, maybe one is a young teacher, the other one is a nurse, they don't have a lot of money, don't have a good credit, they just got married, they just got a baby, and they need a place of their own. So this is residential housing. Governments will stimulate residential housing, okay? So these institutions we call agencies, standing short for government sponsors entity. And government sponsored entity will be lending institutions. They will be like banks. They're not a bank. A bank is a financial institution which makes commercial loans. These will be making other loans, not necessarily commercial, not necessarily for profit. It's going to make a loan to help farmers. It's going to help make loans to help young families buy their own little apartment or house. So these are not commercial loans, and this is not a bank, but it's what we call a lending institution. It will make loans, in this case, non-commercial loans. Next.
Sir,
Yes, question.
this agency loan will it be backed by real estate much like the mortgages?
Not necessarily. Not necessarily. A farming loan may be backed by real estate, as in the agricultural land. It may be backed only by the crop of the land. Okay? Now, residential would usually be backed by the apartment or the house. So in this particular case, they will be making what is called agency mortgage. Agency mortgage is a mortgage made by an agency for the purchase of a house. But the agency itself will issue an agency bond. So an agency will have assets and liabilities. They will finance themselves by issuing agency bonds, that's the liability, and then they will be investing in residential mortgages.
Will the interest rate be relatively lower than the one?
For agency loans, the short answer is interest rates will be usually low. They will be very low. A lot of times they will be below the market rate because it's the government's policy to help these people by giving them cheaper loans. And agency bonds will be considered implicitly guaranteed by the government, so the agencies themselves will be effectively like subsidized by the government. So the agencies themselves will be benefiting by the guarantee of the government, so the agency bonds will be also on a below market value. Below market interest rate. Okay? That's the whole purpose. The whole purpose is to provide a government form of subsidy. And the subsidy is below market interest rate on bonds, and then below market interest rate on residential mortgages and on farming loans. Next, leases. Lease, or plural, leases, could be residential lease. I just had to, 3 weeks ago, sign a residential lease. Lease is a fixed term contract. Fixed term could be 3-month contract, 6-month contract, most commonly 12-month contract, but they may be longer term leases for a car. It may be a 5-year lease. So it's a contract for a specified period of time to make specific payments, almost always monthly payments. So, now sometimes the lease could be just calling for annual payments, okay? For example, my father owns a little bit of land, not a lot of land. He leases it, and he signs a lease, a 5-year lease. And the lease for farming leases specifies clearly that my dad will receive payment once a year. That's how farming leases are done around the world, okay? But if it's residential, meaning a place where you actually rent and live in, okay, it's going to be monthly lease payment. Don't confuse lease with lease payment. The lease will be 12 months, but the payment will be monthly. Usually, okay? So a lease is a contract, it's an agreement. The lease itself can serve as a security. You can sell the lease, and whoever gets the lease will continue to receive the payments, okay? So that's a lease. Usually you will also have, now remember, there's a farming lease. It could be residential, and it could be Commercial. Commercial could be lease for office. You want to rent the office, okay? But commercial could be lease for a truck. You lease a truck, let's say for 5 years. It could be a lease for a taxi. You lease the taxi, the car, okay? That's a commercial. So usually, commercial leases will be either for offices or for some very expensive equipment. So it could be an equipment lease or an office lease. So commercial, let's add equipment. Okay.
What if we use the car, but for all the purposes that just to drive to work or just to use by yourself?
It is still a lease. Again, it doesn't matter what the car is used for. What matters, again, remember, we never say what's the use and what's the purpose. All we said is that it is a fixed period of time where an asset will be used or rented, okay? And you have usually monthly payments. Whether you use it for fun, okay, for medical purposes, for commercial purposes, for farming, it doesn't matter what the purpose is. The question is it a fixed period of time? Does it require usually monthly or annual payments? Is the asset returned at the end of the period? That's it. It doesn't matter whether you drive it for fun or for a taxi, okay? 2 more and then we take a break. Well, you have all studied preferred stock. Is a stock, meaning a share of ownership in a company which is preferred to, next one is called common stock. Preferred is preferred to the dividend. Dividend is the payment made to a stockholder. So, preferred stock will always pay the dividend to the preferred stock owner first before dividend is paid to the common. A different way of saying is that the common stockholder cannot get a dividend bigger than the preferred. Cannot get a dividend that is first. In other words, the preferred gets the dividend first. If there is money left, then the common stockholder will get it second, or actually will get it last. Alright, well, this is a quick, well, not very short, it's an hour-long survey of all the instruments. You'll need to know and understand well these instruments in the first quiz coming, in 2 weeks or so. I'll be asking for 2 or 3 of those.